through my investment framework. So the first step is normally the idea generation part. So normally the easiest way if you're just getting started is just to use a screener. There are many free screeners around nowadays. I normally screen based on quality, ROE, ROIC, and growth, but I tend to relax the valuation parameters to get as many companies as possible. Some companies also may not screen well. Maybe they have some hidden potential in one of their business segments which hasn't surfaced yet. Normally, I will find them either by just reading every annual report or reading articles or analyst reports. Then once I shortlisted a few names, I will carry out the quantitative analysis. I focus on the company's track record of at least 5 years. I like to see companies with a strong balance sheet, high ROE or ROIC, and excellent free cash flow generation ability. The next step is to actually dive a little bit deeper into the business model. Right, a company with clear growth prospects is more desirable. So I often look for signs of alignment of interest between management and shareholders. Because sometimes the annual report that you read, right, the company reveal everything. They only reveal what is necessary. So sometimes when you study the prospectus of another company in the same industry or the peers, can get more information on the industry. Finally, we must balance. I balance the view, all this view on the positivity, on risk or threat. I approach valuation from multiple angles. I normally use a range of outcomes when I want to assess a fair value of a company. So by having a pessimistic, a baseline, and an optimistic scenario in the growth rates and the assumptions that I make, I increase my margin of safety. Here I will present a case study on my thought process for one of my largest positions. It was based on this price chart. What I'm trying to say is that the timing is quite hard. At that time, we can see the catalyst, you can see the growth, but the market doesn't recognize it yet. So it's important to be patient, when investing in and having the conviction, and when you're investing in the company that you believe, because the value can be realized much later in the future, and not necessarily immediately after you buy it. Right? We can see how we position ourselves in some of the Bursa companies. If you widen your horizons and look, across to the overseas market, there are actually other companies available at a cheaper valuation and probably better quality also. I'm sharing this to show that the value investing approach that I practice and the framework that I shared just now does work in delivering these kind of returns. So the key there is that to stay invested and to be patient.